Am I live? Hey everyone. Can any of you tell me if I'm actually live on Facebook? I can't tell if I'm live or not. Let's see. No, cancel. No, I don't seem to be live. No. We're gonna go live using a different browser. Oh, Facebook. We're gonna try this again. Hey everyone, so looks like the live finally worked and that I am live. Yay, okay, awesome. Hey everybody, Leticia here again on this Thursday, sunny, beautiful Thursday afternoon from Toronto for another edition of my weekly Money Matters webinar. And today's topic, as announced yesterday, is life insurance demystified. And I thought it was kind of funny that today is the 13th because, you know, some people think the 13th is an unlucky number and we're talking about life insurance. So anyway, I talk about life insurance all the time because it's part of my profession. So anyway, I think without further ado, and today I will be the speaker and presenter since this is an area I myself am licensed in, have been so for the past over 10 years now, and I work with a large national brokerage firm that allows me to represent many different insurance companies. Anyway, we'll get into, so if you'll allow me, I will, it's so weird not to have a guest today. It's the only session, the only other session other than my initial one that I've done without a guest. All good, I think I can handle it. So I will bring up a few slides I prepared for you, and I will do my best to check in every so often to see if there are any questions. Otherwise, at the end, I will definitely be addressing your questions. Feel free to post any questions you may have in the comments, okay? Thanks, everyone. So, there we are. Yes, and there we are. Okay. I hope you guys can see my screen, okay? So, you know, first of all, we're going to talk about what is life insurance, why and when is it needed? How much insurance do we need? And what type is best for what situation? So, I may be biased, but I do believe that life insurance is an amazing financial instrument. It allows us to create a large pool of capital, creates an instant estate. So somebody who may not be worth much when alive, they could be worth a lot more if they purchase, when they pass on, if they have life insurance. And then there are actually many different uses for this, for life insurance, and we will be addressing some of those. Now, I promised, first of all, yes, let's talk about why do we even need life insurance. So many of us insure our valuables, and I guess the question is, why do we even insure our valuables? Do you insure your home, your car, your expensive jewelry? And now some may say, well, the government forces me to have these types of insurance. But the reality is that if, God forbid, your house or any of our homes were ever in a fire, you wouldn't want to have to come up out of pocket with the money required to replace and rebuild your home. So that's why we need insurance for our valuables. Same thing with your car. God forbid your car or any of our cars were to get totaled in an accident. Do you want to have to come up with the entire amount out of pocket? Not likely. So we offload that risk to an insurance company. And same thing for our jewelry. However, the interesting thing is, if we really think about what is our own most valuable asset, financially speaking, of course, emotionally, of course, we're our own most important asset. But when we think from a financial perspective, few of us stop to think about, even on a modest income, adjusted for modest inflation at 2.5%. Right now, we're living in higher inflationary times. But let's say somebody earns $35,000 a year, starting at age 25, and that increases very modestly at 2.5% per year. By the time that person reaches age 65, they will have earned $2.3 million throughout their lifetime, throughout their working career. A person earning $50K a year would have earned $3.3 million. Somebody earning $90K a year will have earned $6 million by the time they're age 65. Assuming they started their career more or less at age 25, as you can see, of course, the more years you have of work, the higher that number is. But if you really think about it, any one of us is a millionaire in the making, may have already made millions by now, and are likely to make more millions as we continue our working careers. Now, you may get to a point where, and hopefully we all get to that point, where most of your income now is coming from passive type investments. You've got your money working for you more than you yourself are personally earning that money through whatever occupation you've been engaged in. So the idea is, when you're at work, it's your income that is providing for your family, for your loved ones. When, God forbid, anything were to happen and you're no longer able to provide for your loved ones, that's when insurance can replace you, at least financially. Of course, none of us can be replaced emotionally, not fully anyway, because we're all unique and amazing. Insurance can at least replace you financially so that your loved ones can be protected. So now, again, we can talk about how much insurance, and I'd like to talk about it in a second. But essentially, if you ask yourself, why do I even need insurance? If you have anybody dependent on you financially, whether it's minor children or a spouse that maybe doesn't earn as much money as you, and it's your income that is providing for most of your lifestyle. In this day and age, usually when couples live together, I find that usually both incomes are required to provide for the lifestyle. That's just the world we're living in. So usually when I'm dealing with couples, they may be earning a similar amount of income, but if any one of them were no longer there, the partner would be oftentimes hard-pressed to be able to maintain even the living expenses on their own, because that's the world we live in right now. Two incomes are usually needed. Of course, those of you who are single or single parents like myself, and if you have any dependent children, well, it's even more important to be able to make some sort of provision for your loved ones in case, God forbid, you're unlucky enough to not be here anymore, okay? Now, so again, what we usually look at in terms of a person's need for insurance is, well, what is your lifestyle right now? Is your family relying on 30K a year or 50K a year or 60K a year to support your lifestyle? Do you have minor children? How long does that child have until age of majority, or until realistically they will be on their own 2 feet, which is likely after some sort of post-secondary diploma education in this day and age. So we look at what would be the replacement value of your income for that period of dependency. Now, another common reason people choose to put in place life insurance is because they've just bought a home and they now took on a 500, 700, depending on the kind of real estate market you may be in. In any case, we're talking about a multi-$100,000 obligation on your shoulders. And again, if you're the one paying the mortgage or part of the mortgage, if all of a sudden you're no longer here to be able to provide for that, this is where life insurance can be used to cover at least the balance of the mortgage, so that your family at least can remain in that home, or is not hard pressed to have to sell the family home in a fire sale because the lender is knocking on their door within, maximum 3 months. So those are the types of situations that we discuss, and some of the very common needs for life insurance. Now, we also talk about things like any one of us will have some level of final expenses to cover. We may take into account if you want to provide any funds for your children's post-secondary education. And then there are more advanced needs. So for people who have been hardworking, diligent, fortunate, whatever the case may be, and they've actually built up some wealth, they may have investment properties, they may have investments. Unfortunately, that attracts certain tax consequences. And in Canada, in any case, and most countries in the world, there are taxes to be contended with, things like capital gains tax. So insurance can also be used to provide liquidity to the estate in the case of people who have these more advanced needs. And I say that because the majority of people maybe own their principal residence, or I would say most people have the basic level of needs. If you have any minor children, you may have a mortgage. Those are very common needs. Now, the moment you start getting into things like investment properties, or you've done well with other types of investments, whether it's the stock market or what have you, an additional level of needs analysis needs to be done to determine those level of needs. Okay, moving on. Which type of insurance is best for you? So we're going to talk about the different types of insurance available in the marketplace. And again, we're talking about life insurance. By the way, before I do that, I didn't have a chance to put a slide on this, but I come across certain common misconceptions. And one of them is that, oh, I thought insurance only pays if you pass away in an accident. That's not the case. There are very basic limited types of policies in the marketplace called accidental life insurance, and they're often sold as AD&D, accidental death. They're called accidental death and dismemberment. Dismemberment, geez, terrifying word. Oftentimes you'll get a call from your bank offering you that type of coverage, and it will cost you next to nothing, $7, whatever it is. Now, those types of policies, they are valid. And if a person were to pass away as a result of what's called blunt force trauma, literally a fall, a car accident, falling off a roof, what have you, then you'd be covered. Now, the types of policies, a traditional life insurance policies, policy, and the ones that I have access to are actually cover people for all kinds of causes of death. So it doesn't have to be an accident. It could be, God forbid, cancer. It could be any really anything. The one life insurance claim I've had to pay to date was a very freaky situation. It was just a very unusual set of circumstances. I actually had a client get into an altercation with someone, and somebody pulled a gun, not a gun, a knife. It was in a certain community I don't want to mention, but where things like honor is very important. So unfortunately, even in that case, because my client was an innocent victim in that case, insurance paid. In this case, it was Sun Life. The claim was settled within a matter of days. Okay. Now, and again, they had to get the police report and all that. But I mean, that's a very unusual circumstance. But I just want to give you an example that essentially, once the client is approved for coverage, there are no limitations like that. Now, the only limitations are if a client is found, after the fact, it becomes apparent that fraud was involved, okay? The client didn't declare an important health condition and somehow they got through the underwriting process, not disclosing that. Never advisable to lie on a life insurance application because you could be paying premiums and your family in the end would not get anything. So that's something we obviously discuss as we're going through the underwriting process, and I'll explain to you guys what that's all about. So usually, and especially in the first 2 years of a policy being enforced, there's something known as a contestability period. So that's when the insurance company is likely to do more digging. Does this person lie about anything? One thing, again, you don't want to ever lie about is smoking status, okay? And again, we'll talk about that when we talk about underwriting. But smoking status is a cause for, first of all, higher premiums. Smokers generally pay anywhere from 40 to 60% higher premiums than non-smokers. Unfortunately, higher mortality, like statistically speaking, and insurance companies have these types of statistics to show that there's higher mortality with somebody that's especially a long-time smoker. Now, the good news is, and again, I wish I had a whole section on underwriting, and maybe I'll do a future session in the future, because there are many health conditions that people may have and they may have questions about. But smoking status is a common one. The good news about smoking status is that after 12 months of being a non-smoker and declaring yourself a non-smoker and passing a blood test to show that you're a non-smoker, your premiums can be reduced back to what the original non-smoker premiums would have been. So even if you applied as a smoker, let's say 5 years before, and then 5 years later, that's it, you're not smoking anymore, you've been off the smokes for 12 months, you can come back to me, I'll help you obviously as your advisor, as your broker, but you could go back to the insurance company and say, okay, I'm no longer a smoker, pass a blood test, and then they would honor the non-smoking rates that would have applied even at the initial time of application. So that's a nice little thing. Anyway, I didn't plan to get into these underwriting details, but I just wanted to make it clear that life insurance policies are comprehensive and they cover various causes of death. Now, there is, even suicide is covered, okay, as long as it didn't take place in the first 2 years. Okay, and the reason this came about is because there was a famous court case. In the past, insurance companies did not used to cover suicide as a cause of death. Well, there was a famous court case that in my understanding went all the way to the Supreme Court of Canada, where a man committed suicide. The wife argued that, that policy had been enforced for a long time. How would she or he have ever known that later on the man was going to become depressed, stressed, whatever led to the event? So essentially, due to that court decision, the situation is that most insurance policies out there, which is like 99% of the market, will cover suicide unless it happened in the first 2 years of the policy being enforced. I'm not encouraging any of you to contemplate such things, but it is a common misconception, and I wanted to just address it, okay? Now, there are a handful of policies, especially in the realm of what we call simplified issue. These are policies for people that are harder to insure. Those may have exclusions absolutely for suicide, and those should be addressed by the advisor at the time of the sale. But those are a handful of companies. The majority, 99.9% of standard policies, it's only the first 2 years that have that exclusion. Okay, now let's get into the different types of insurance, you guys, okay? In Canada and most of the world, insurance products have been standardized. So we have what we call term insurance, and then we have different types of permanent products. And as you can see, and I will cover those in the coming slides. So term insurance works like a ladder. It starts off being very inexpensive, eventually becomes mucho expensive, and now, most term policies in the marketplace, even if a client is willing to pay the higher premium as they get older, typically will expire at age 85. There is one company in Canada that will go to age 100. Again, I don't see many people, almost none, that will actually keep paying those higher premiums, because we're talking about thousands of dollars per month. It becomes really pricey to keep a term policy in force at that point in time. But term policies are initially attractive because you can buy a large amount of coverage for a relatively small monthly premium. And there are cases where that's desirable. So for example, you took on a $500,000 mortgage, you took on a $700,000 mortgage, you may have 3 young children. So you need a lot of coverage but you don't want to pay an arm and a leg because you're already paying a mortgage payment, you're taking care of children. So that, this is your typical young family. They have lots of responsibility. Financially, they are tight. So at the same time, they want to protect each other. They want to protect the family. Term insurance actually offers a wonderful solution for that, because you can buy a large amount of coverage for a small monthly premium. And I'll show you guys just an illustration. In fact, I can bring it up right now. Let me see if I can do that. Do a new share. Yeah, where would it be? I have my Facebook wall, but I don't have it here. Let me see if it's here. Yeah. No, sorry. There you go. So I actually ran a quote here for $1 million policy, and it's what you call a term 10 policy. So by the way, when it comes to the reason it's called a term is because every 10 years or so, depending on the length of term that you choose, it could be a 20-year term. In that case, every 20 years, the premium goes up. And it goes up to a certain predetermined level, okay? So just to give you an idea, for a 40-year-old non-smoker male, you could get $1 million worth of coverage for around $52 a month, okay? And by the way, men generally pay more for life insurance than women, not generally, but always, all things being equal. Women, we tend to pay more for other types of coverage, such as disability insurance. So women tend to live longer than men, statistically speaking, but we also have higher morbidity. Things like osteoporosis affect women more than men, things like that. So $1 million of coverage for a non-smoking 40-year-old female, you're looking at $36 a month, $37 a month. Now, as you can see, I have access to a variety of different companies. There may be reasons why we'll go with one company versus another. Some of the things to consider, and people may say, well, isn't it all just term insurance? And partially that is true. And just so you know, another question people have is like, how do I know that they're actually going to pay? And especially in the uncertain financial times we are in right now, people may be concerned, oh my gosh, what if a company goes belly up? How can you ensure that my family is actually going to get paid? Well, just so you know, in Canada and most of the civilized world, as far as I know, I'm only licensed in Ontario, and I have colleagues that work in other Canadian provinces, and I have a colleague in the US who is licensed in most of the US states. We can talk about that later. But we have something in Canada, we have something called assurance. So just like banks are protected by a third-party insurer called CDAC, it's a Crown Corporation, Canada Deposit Insurance Corporation. So if a bank goes belly up, your bank deposits up to a certain level are protected by the CDAC. Similarly, insurance policies are covered under assurance, and you can check it out. It's assurance.ca, ASSURIS.ca. So, don't quote me, but I think it's like if it's a policy up to $200,000, it's 100% covered. So in other words, in the unlikely case where an insurance company were to go belly up, your policy is insured by assurance. Now, in reality, what tends to happen is that there's always a bigger fish that is happy to buy out the smaller fish. So back in 2008, we had a company, you might remember, let me see if I can remember the name. Was it AG? I want to say AGF. No, AGF is mutual funds. I apologize. Oh my God, what was the name of it? I'm completely drawing a blank right now. But anyway, there was a major insurance company that was bailed out by the US government. The Canadian division ended up being put up for sale. And BMO bought it at a discount. So there's no better business than a cash flow business. Insurance companies collect premiums from policyholders and on the promise of eventually, hopefully later, rather than sooner, paying a death benefit, okay? So at the time, BMO, one of our major banks, was on the lookout to have their own insurance division. So they simply ended up buying the entire Canadian version of, oh my gosh, what was the name? AIG. It wasn't AIG. It was AIG. What am I saying? AIG. It was AIG. AIG. So yeah, essentially, I had clients who had AIG policies. The only thing that happened, nothing changed for the policy. they started getting their statements from BMO. So now instead of their policy having AIG at the top, it had BMO insurance at the top. Nothing changed for the clients. The same promises of the policy stand, and everything's equal. So I'm going to go back. I just wanted to show you guys, because one of the other concerns people have is like, oh my gosh, how much is this going to cost me? And yes, I'd like to have life insurance. I understand that my kids need it. It would be, it'd be good for me to have it, but I can't afford it. Well, okay, I'm just showing you how affordable the premiums can be. Now, again, why are we even looking at a term 10 type policy? That is the one of the shortest lengths of term available. And, if somebody has minor children, depending on the age of the children, we may be looking at a term 10, we may be looking, some people feel comfortable locking in for a term 20. One thing I'm not showing you here is that there is an automatic renewal premium set. So at the 10-year mark, premiums would renew automatically to a higher rate. Now, that said, if you're still in good health at year 10, you don't have to take the automatic higher renewal premium. You could say, you know what, I'm willing to go through underwriting again. I'll go to market again. And you better believe that you're going to get a better premium than what the automatic renewal premium would be. Because the automatic renewal premium includes people whose health has declined to such a degree that they would not be able to go to market. They're essentially, their automatic renewal is their only option at that point, because for whatever reason, they might have had something very serious happen to their health, and now they're basically uninsurable. So, man, I'm talking a lot. I kind of want to see actually if there are any questions. I think you guys are in my brave. Oh man, I would have to minimize this. Okay, let me go back to my slideshow. Yeah, no, guys, I can't have too many windows open. I'll figure it out. I'll go back and check questions at the end, but hopefully that explains term insurance. Now, the interesting thing about term insurance is, again, somebody could start off with a very inexpensive policy for a large amount of coverage. Okay, let me back up a bit. So one of the recommendations, general industry recommendation, is that people should cover temporary needs with inexpensive term insurance, and they should cover permanent needs with permanent insurance. So let's talk about, and we're going to talk about that in a second, but temporary needs are, a mortgage. After a while, hopefully you'd have paid it off. Now, if you're an aggressive investor, you may never pay it off, but then you're going to have some other types of needs, as we discussed, tax type needs. But again, temporary needs, your children's dependency period is one such temporary need. And the idea with the term insurance policy, okay, after 10, 20 years, you no longer have that need. You can go right ahead and cancel the policy at that point in time because you no longer need it. Now, if in time you have accumulated some wealth and now all of a sudden you find yourself having some permanent needs, so estate planning, taxation type needs, the cool thing with the term insurance policy is that with no medical questions asked, you will have the right to convert to a permanent type policy later in life. So even if your health, maybe when you applied, you're young and healthy, later in life, some things have happened to your health, and now you may not be able to qualify for a policy in the marketplace. As long as you've held on to your term insurance policy, you can trigger what's called a conversion option, and now you can find yourself the owner of a permanent policy. Now, the only caveat with that is that the conversion will be, the rate at the time of the conversion will be based on however old you were at the time. So if you do the conversion when you're 55 versus 60, a different rate will apply based on whatever age you may be at. But again, the good news is no medical underwriting. It's an automatic privilege that's built into the policy. So anyway, I think we covered enough about term insurance. On the opposite end of the spectrum, we have in the marketplace permanent policies. So one type of permanent policy is what this illustration calls a lease. It's a pay-as-you-go type policy. So think about it as taking a term policy, and instead of you paying a little bit at the beginning and higher later on, it's as if you stretch the term policy over 100 years. And in fact, we have plans in the marketplace that are called a term to 100, which is literally you take a term policy and you stretch it over 100 years. Now, I'm not usually a big fan of this types of plan, especially when I'm dealing with younger clients, because if I have a client who's 40 years old And even if they have a permanent need for coverage, do I really want that client paying a premium when they're 85 years old, 95 years old? They may have Alzheimer's, who knows, you know? So this is why we call this a lease, because you're always paying. It's a pay-as-you-go type plan. Now, there may be cases where this is justified. If I'm already dealing with an older client and maybe this is their most affordable option at the time, and they have provisions, they have the funds in place to make sure that a premium gets paid until the last month, you know, until the very end, so that their family will get the money. For sure, there are some cases where this type of plan makes sense. The other option is what we call owning the policy. So you actually have the option of paying a premium for a permanent policy for 10, 15, 20 years only, after which the policy is paid up, no further premiums are required, and the policy remains in force for life. So as you can see in this illustration, you get to a certain age, you know, 10, 15, 20 years from the date that the policy was put in force, where you no longer now need to make a premium, policy remains in force for life. In addition to that, as you can see here, these types of policies usually have what we call a cash value component, an investment component, okay, which will continue to grow. So this is sort of, and I'm gonna get into the investment component shortly, but essentially the policy comes with a built-in investment component. That investment component will continue to grow even past the point of you stopping the premiums. So compare that to the last illustration. So here, to give you an idea, let's say we started with in the lease option, let's say we started with a $500,000 policy. Well, if you buy $500,000 today and you don't have that investment component on the policy, what you see is what you get. What you pay for is what you get. And we all know that in time, the value of money, unfortunately, due to inflation, gets eroded. So that $500,000 today may seem like a lot of money. 20, 30, 50 years from now, it may not be all that much. Having this investment component as part of your policy, whether you do the prepaid type policy, or even if you do a pay-as-you-go type policy where you have that investment component, allows the policy to, at least to some extent, keep up with inflation. And again, we're going to talk about the different types of investment components and all that, but at the very least, you're not, you know, your 500,000 could in fact hold its value because you have this investment component that gets added to the life insurance benefit of the policy. So by the way, I use different terms. I've used the term death benefit. That is, death benefit and life insurance benefit are one and the same. They refer to the amount of money that your family, your loved ones would get, okay, if you're no longer here. And by the way, you have the option to name specifically who you want the money to go to, and so many exciting things to talk about. One of the benefits of life insurance is that it goes directly to the named beneficiaries, bypassing the probate process. That's something we're going to be discussing next week when we have a lawyer on our call talking about wills, powers of attorney. Good stuff to know, at least I think so. And hopefully you'll agree. So in the realm of permanent policies, guys, now, so I said to you guys, there are term policies and then there are permanent policies. Some permanent policies are pay as you go. Some permanent policies you can choose to compress the premiums, and I've already explained all that. In the realm of permanent policies, you may hear the buzzword universal life and whole life, okay? So I'm gonna talk briefly about both of those because I want you guys to know what the differences are in case somebody else, not me, tries to sell you either one of them, okay? So the investment, so we spoke about how some permanent policies have an investment component. Now, I said to you guys that you can have what's called a term to 100 policy, which is taking a term policy, stretching it over 100 years. Those term to 100 policies do not have any investment component. If you get the 100,000, it's 100,000 and that's it. Now, you could choose to put in place something called a universal life policy. A universal life policy, you can still choose to pay it on a pay-as-you-go type basis, but you can choose to add on this investment component. So in the case of a universal life policy, this investment component is usually optional. So you can choose to do just pay-as-you-go, pay the bare minimum to keep the policy in force, which is also known as the cost of insurance. And that will be based on your age, your smoking status, your health at the time of application, okay? Or you could choose to put in some additional sum of money. Now, that additional sum of money, which is known as the cash surrender value of the policy, or this investment component. So in the case of universal life policies, this investment component is, as you can see, first of all, it's optional, so you can choose to contribute it or not. You can pause it, contribute it, all of that. Or, so it's optional, and it is linked to the performance of certain market indices. So you as a client can say, okay, well, I want my universal life policy investment component to mirror the returns of the TSP 500 or the S&P 500 or of an equity-based portfolio. So what you're going to see is that if that particular market index or mutual fund that your investment component mirrors does well, your investment component is going to do well as well. If it does poorly, to the extent that you are in any way linked to equities, you may see your investment component fluctuate up and down, okay? But again, to the extent that in time you build up some investment component, when you passed away, your family would get the initial 500,000 plus whatever money accumulated in the policy. Not every universal life policy is structured like that, but depends on how it's structured. You have the option of adding on the investment component to the death benefit of the policy, thus accomplishing what I just explained, the idea of keeping up with inflation, at least to some extent, okay? So universal life policies, guys, were very popular before the dot-com crash, before the 2008 market crash, because in times when the equities market are doing well, people think, oh, well, my RSPs are doing great, my stock portfolio is doing great, why not? I'll go and put my UL is short form for universal life, I'll put my cash value in equities as well, or I'll have it mirror equities. Now, unfortunately, we've all seen what happens. There can be downturns, so not every client has the stomach for that. And now you could have the option of putting your investment component in something that's akin to a GAC, but then your returns are 2% net of inflation is nada. So you as a client have a lot of flexibility. Another reason people like these policies is that, by the way, and I'll explain that in a second, but essentially this investment component grows on a tax sheltered basis. So similar to an RSP or a TFSA, as long as your money is being put inside this investment component of the policy, it grows on a tax sheltered basis. So the government is not gonna send you a tax bill every year for your interest or whatever type of income you've been earning. So tax shelter. So people who are in a position where they've already maxed out, maybe they're a high salaried income earner, they've already maxed out their TFSAs, they've maxed out their RSPs, they're looking for another tax sheltered investment vehicle. This is where this type of policy can come in handy, because up to a certain legally allowable limit, the CRA will let you tax shelter money up to a certain amount. So you can literally overfund this investment component and stash some money in there, okay, up to a certain legally allowable amount. So that's one area where we can still see these policies being used. Not the only area, but just to give you an example. Now, also in the marketplace, when it comes to permanent policies, you may hear the buzzword whole life policy. Now, the investment component of a whole life policy is not optional. So if you pay $100 a month in premium or $150, whatever it is, part of it goes towards the investment component. It's a built-in part of the policy, okay? And as a client who has a whole life policy, you're not gonna be able to pick and choose the investments. The investment component of the whole life policy gets managed institutionally by the insurance company. And how it works is that they literally take the premiums from all their whole life policy holders. And again, you may hear the buzzword participating, non-participating. I don't want to get into that but in general, how it works is that they take the premiums from all the policyholders, and we're talking about millions, sometimes billions worth of money that they now invest as an institutional investor into the markets. And because they're institutional investors investing such large sums of money, they are in a position to invest in things that you and I as retail investors may not have access to. So things like commercial real estate, commercial mortgages, infrastructure projects, things like private placements, which I can hardly, it's investing, essentially more sophisticated types of investments that usually would require large amounts of capital. And also because they are investing such large sums of money, the fees they pay to invest get to be lower than what you would pay on a regular mutual fund, because you're a retail investor investing small amounts of money. Ironic how that is. We pay more, when you invest a small amount, you pay more, but you invest larger amounts, you get to pay less. But it's kind of like, that's usually how it works. So how it works is, again, the insurance company goes out there, invests this large pool of capital, and then every year, based on the performance of this pool of capital and other factors such as how the mortality rate was that year, how much money did we have to pay in claims? Oh, well, we are living in times of increasing longevity. That may surprise some of you, but that's been the case up until now. Who knows what's going to happen moving forward, but that's just been the case. We have been living in times of increasing longevity. So insurance companies usually have to keep a certain amount of funds in reserve required by the regulators to be able to pay out claims. But because we've been living in times of increasing longevity, the insurance company can say, well, we can actually give back some of this. We don't have to hold as much money in reserves. So we're going to give some of this back to our what we call participating whole life policy holders. So what forms the dividend component is a variety of things, but again, it's generally based on the performance of this pool of capital. So how it works is that every year, whether it's Canada Life, Equitable, Sun Life, whichever one of the companies that offers these types of plans, they declare a dividend and say, we're going to give some money to our participating policyholders. Once the dividend is paid, it becomes what's called vested. It cannot be taken back from you. So if you had, let's say, I don't know, $50,000 in the investment component of your whole life policy that year, they paid you another $5,000. Regardless of what happens in the markets next year, that $5,000 becomes vested. It's your money. It cannot be taken back. So as compared to a universal life policy where that investment component of yours can go up and down, with a whole life policy, once that investment component is paid, that's it. It cannot be taken away from you. It's yours. Okay. So by and large, whole life policies are seen as, and by the way, this may come as news to you, but insurance companies have had these types of policies on the books for the last 150 years. So companies like Canada Life just celebrated their 200-year anniversary, and they've had whole life policies on the books since as far back as 150 years. And I just want to give you guys an idea of what happens inside this type of investment component. Was I here? Yeah, I'm gonna share. So, and if you're wondering, well, but how much, what kind of returns am I going to be getting on average? As I explained, with the universal life cash value component, it can go up and down depending on what type of investments you're linked in. With whole life policies, we know, because we have so much history, you're looking at a 4 to 6% net rate of return long term. And again, we can say that because we have such long history with these types of assets. So yes, it will look much better than a GAC at the bank, okay? At the same time, you're not going to be getting 20% returns if that's what you're looking for, okay? And essentially what insurance companies also, because we're talking about such a large pool of capital, that gives them the flexibility to level off the returns. So in years where the stock market might be doing 20%, they're not going to give you a 20% dividend or return on your money. They might give you 8%, okay? But on the plus side, in years when the market is doing negative 20%, you're never going to get a negative dividend. Now, all these companies say, well, dividends are not guaranteed. Yeah, okay. The reality is the amount of dividend is not guaranteed. But if you look at companies like Canada Life, we have a history. This is just the last more than 50-year history, since 1950, since the year 1950. There's never been one year there's never been 1 year where they didn't pay a dividend to their whole life participating whole life policyholders. The these types of policies are sort of like the bread and butter of insurance companies, and they want to keep their policyholders happy. So to give you an idea, look at this. So the S&P back in 1950, the stock market was going through the roof. Well, you were getting kind of a modest rate of return. There was 1957, there was a recession, negative 20%. Well, they still declared a 7%, 7.3% dividend that year. Now, out of this, again, you have to deduct what's called the cost of insurance, which is why your net average is going to be a bit less than what you see here as the declared dividend. In any case, as you can see, so this type of returns or the performance of these whole life policies can be seen as a steady eddy type of asset, okay? It's not for somebody, as you can see, if somebody's invested in equities, they will see huge rises, but at the same time, potentially huge downs. So look at this, 1974, there was another, I'm not sure what happened, inflation was over 10%. I'm scared about what's coming, but look at that. The market was like negative 25%. They still paid 9.2% dividend to their participating policyholders. So this sort of asset, again, it's a steady eddy asset that has, and I'm talking about it as an asset because many people think of these types of policies that have an investment component as a separate asset class, especially these whole life policies. As you can see, no roller coaster for you. It's a steady eddy type assets. I have one of these policies for my son. I've had it since he was 2 years old. They actually look particularly attractive for children because the longer time horizon you have for the investment component to grow, the longer it will grow. So obviously, the younger the child, the more time the money has to grow. But as you can see, at the same time, government bonds. It's hard to see. I wish they were showing. What they're not showing is like what the GICs were doing at the time, but we all know. So look, as late as 2010, that's the latest. They might have updated this flyer. I gotta look it up if they have a new version of this flyer. But we've been in a low interest rate environment in recent years. Therefore, dividend scales, they do tend to go along with that. So the higher the interest rate, the higher you're gonna see the dividend payout be as well. But I don't know what GACs were paying in 2010, but for sure it wasn't 7% because I've been in Canada for long enough and it's always been like 2%. Like the last recent years, it's just been very low rates of return on those guaranteed investment certificates. Whereas here, I'm not gonna get into any further details on that. Whereas here, again, you're gonna get a rate of return superior to those types of fixed asset portfolios such as bonds or GICs, at the same time without the roller coaster type effects that you're going to see if you're just fully in equity. So somewhere in the middle, okay? Let's have a look here. I think I got a little bit into the weeds. Let me stop share. Okay, all right. I'm going to try to speed up through the last slides. So anyway, why are we even talking about this? Again, I wanted to explain the difference between universal life policies versus whole life and how the investment component of the whole life policy is different from the universal life policy. That being said, again, people may be like, well, who cares? Can I access this investment component while I'm alive and well, or do I have to be dead to be able to access it? And the good news is whether you have a universal life policy or a whole life policy, the client can access the investment component of this policy while they're alive and well. Okay, I already explained the fact that with both types of policies, the investment component of the policy grows on a tax sheltered basis. So these assets are often seen as a complement to a TFSA or RRSP. Okay, they're one of the few tax havens that we have in Canada, okay, and in the Western world. Now, you may say, well, how can I access this investment component? Can I just go to the insurance company and say, I want to withdraw some money? with some policies, you can do that. However, keep in mind, your money has been growing on a tax sheltered basis. The moment you do a direct withdrawal, you're going to have to all of a sudden pay tax on that money, and it may also affect the final payout of the policy, because remember, in some cases, that investment component gets, when it comes to UL policies, in some cases it gets added. When it comes to whole life policies, the investment component always affects the final payout. So the larger the investment component, the larger the final payout of the policy will be. And I'm going to show you guys an illustration so you have an idea. Now, so the better way to access your money would be via what's called a policy loan. You can go to the same insurance company, or you could go to your bank. Now, don't go to your teller at the bank. You want to go to what we call, the private banking division of the banks. Because these assets, these types of policies have been in existence for so long, banks are actually very familiar with these types of assets. So let's say after a certain period of time, you have $50,000 accumulated in your whole life policy or your UL policy. You can actually go to your bank and say, hey, I want to borrow some money and I have collateral, I have cash value in my policy. So essentially you can access your money and then you can do whatever you want with the money. And because the money is, you're essentially taking a loan and it's a collateralized loan, you don't have to pay tax on the actual proceeds. And as a matter of fact, many people who have taken advantage of these policies and have these policies in force, they are using them as an additional source of retirement income. So you get to a certain age and you can actually create a whole new pension, a private pension for yourself. And in fact, this is a whole strategy that applies in particular for business owners. It's called an individual pension plan. So you can literally create, using one of these policies, you can create your own pension later in life. This is just one of the strategies. There are other exciting strategies that we're going to get into perhaps on a future call. But the idea is, yes, you have every right to access the investment component. If for whatever reason, maybe your credit is not good, the bank may say, well, I don't know, yes, even though it's a secure loan, well, you can always go back to the insurance company themselves and get a loan. And they will literally lend against the cash value of your policy. Now, because with UL policies, and again, I might be getting into many deals, remember, with UL policies, that cash value component can fluctuate. So usually lenders will lend up to 50% of the cash value on a UL, but there are some lenders that will go all the way to 100%. It's as if, think about it as a home equity line of credit against the equity of your policy, but going to 100% equity. They're not asking you to keep any equity in there. They'll give you up to 100% loan on a whole life type of policy because of how safe these assets are perceived to be. Okay, so lenders, insurance companies are so confident and comfortable with this type of assets, and they know the long-term performance. They know that once that dividend gets paid to you, it cannot be taken away. It becomes vested, so their money is protected. And so how this would work is that, okay, you now take your 50K, you use it to supplement your retirement, or you use it for that vacation or whatever, or maybe for home renovations, whatever you may like. Okay, now you can choose to pay back the loan, okay, in which case your cash value component would be intact, or you could say, you know what, I'm not going to pay it. When I pass away, the insurance company will get the money from my life insurance payout. Either way, this could work. Okay, so it's a very much a win-win scenario. You get to have your cake and eat it too. You can access some of the benefits of your policy while you're alive and well, and then later on, your family would still get some money. And I want to give you guys an idea, because I think only with, I'll get to that slide after, but I want to show you just how spectacular this investment component can grow in time, and how much it can make a difference. Okay, I want to make sure, new share, yeah, that's where it is. Okay, share. So I just out of curiosity, and also to show you guys, I ran an illustration for a 40-year-old male for a $150,000 whole life policy. I chose to do it as a 20 pay. So after 20 years, no premiums are required. This person only pays for 20 years. After that, nothing is required. Now, remember, earlier I showed you an illustration for $1 million for a term 10 policy, and it was only coming to like $50 a month. In this case, premiums are quite a bit more. And in this particular case, I'm also supercharging the investment component. I'm doing something called accelerated deposit option, which supercharges the investment component of the policy, because I just want to show you kind of like the potential of this policy. So in this case, this client is paying an annual premium of $6,500 a year, 65, 61 on, this is your left side column here. And he's only paying that for 20 years. So at the end of 20 years, that client would have paid $131,000 into the plan. If the dividend rate remains as it is right now, and by the way, we are actually, because we've been in such a low interest rate environment, dividend scales, as they're called, the dividend rates have also been lower than in the past because we've been in a very low interest rate environment. So I'm actually pretty confident to say that whatever the dividend rate may be right now, it's not going to get much lower than it already is. As you can see, there have been, so we're sitting somewhere about 6.5% right now for most companies. In the past, we've had years when it was like 11, 10, 12%. We're not in those kinds of times, not yet anyway. So to give you an idea, after 20 years of the client contributing, based on the current dividend scale, he would have paid a total of $131,000 into his policy. By year 20 alone, he would have $185,000 approximately. Okay, the death benefit of the policy went from $150,000, and as you can see, it starts growing from year one. Yes, he started off with a $100K policy, but it actually starts growing and growing and growing. By year 20, this client will have an approximate payout, God forbid something happened to him then, almost $400,000 policy. Not only that, but after year 20, this client is no longer paying a premium. He's done, because that's what we did. We did a prepayment of the premiums. The policy continues to grow. Look what happens to the investment component, okay? By the time that client is, okay, so the client started when he was 40. By the time that client reaches, age 70, he would have $320,000 in his investment component, having started with nothing. Like he didn't start with anything. That just grew and grew and grew. Okay, the life insurance payout from $150,000 grew to over $500,000. Okay, if he lives to life expectancy, which is for men currently age 84, let's say 85, that $150K policy that he put in force when he was 40 years old is now going to be worth, at age 85, will be worth $775,000. Okay. And I know all of you are probably thinking, well, what about inflation? Well, again, when you supercharge investment component and you're getting, in this case, even more than that 4 to 6, again, we'd have to look up, what the actual return is. But I would say at the very least, you're keeping up, at least you're at least to some extent keeping up with inflation. And at the same time, creating an additional source of income in retirement for yourself, for your loved one, for whoever. Well, again, as a parent, you can put one in place for your children, for your spouse. There has to be what's called insurable interest. You can't just put it in place on a stranger on the streets. Like, what are your intentions? Why are you buying life insurance? So there has to be something called insurable interest. But anyway, I wanted to show you guys just the potential of these policies, that you can start with pretty modest 150K policy. So again, a lot of people are looking at these as an alternative asset class, as another type of investment. And again, if you're a high earning professional, this could be something else that you could be looking at, in addition to whatever else you may be doing. And again, it also serves the benefit of providing a large benefit to your estate, which could be used to take care of taxes if you are in a position that your estate is going to have a tax bill. I'm going to just finish off my slides, and I'll look to see if there are any questions, okay? Okay. In terms of, what type of policy would be good for you, it depends on what stage of life you're at. It depends on what your needs are. So as we discussed, for a young family just starting out, they usually have more debt than assets. They have more liabilities than assets. They have young children that are going to be dependent for quite a while. They have a mortgage or mortgages. As a person advances in life, in age and in life, to the extent that they've been successful financially, they may have these longer term estate planning needs. So tax liabilities that need to be covered and insurance. And in this case, we're usually looking, so just as we discussed and talked about the fact that temporary needs are best covered with inexpensive term insurance, if you've got a permanent need, sooner or later, you're going to want to address that with some sort of a permanent life insurance solution. And again, I've done other presentations on this for other groups, and I likely will do that presentation again about talking about creative ways of financing the premiums for, or not really financing the premiums, but creative ways of putting in place a permanent policy, even a sizable permanent policy, because the premiums for permanent policies are much higher compared to term insurance, but that's also because of the benefit that you're getting. As long as you pay that premium for, as long as you choose to put it in place to pay it for, whether it's 10 years, 15 years, after that, the policy is, the company is on the hook. They have to pay that benefit. Like you've paid the premiums, they have to pay it. Whereas with the term policy, well, client paid for a few years, they later decide to cancel it. You didn't put out a whole lot, but the insurance company is also thinking, well, especially with young clients, well, hopefully nothing happens. Statistically speaking, nothing will happen. So, you've paid the premium for a number of years, but now you also no longer have the coverage. But again, the term coverage is beneficial and useful if you are in that stage of life. So I don't want to diminish the benefits of the term policies, because at the end of the day, what's the best type of policy? It's the one that was enforced when the client needed it and when their family needed it. So just a slide, you know what, I'm not even going to get into this because this is going to get too long. There are business uses for insurance. I'm going to do a whole separate presentation on corporate insurance and the needs for that. Very interesting and very cool stuff. And I find a lot of business owners are just not aware of some of the solutions that are out there to basically safeguard what in many cases is the biggest investment of their life, which is their business. In terms of the application process, in case you're wondering, hey, okay, this sounds interesting, Leticia. If I wanted to look at some solutions for myself, what's the process like? Number one, we would do what's called a needs analysis to figure out, how much coverage do you need based on your current situation. Obviously, everything we discuss is confidential. As a licensed insurance advisor, I am bound by my fiduciary responsibilities to maintain client privacy and also to act in the best interest of the clients. So once we determine what your needs are, then we look at the ideal plan design. Is a term solution ideal for you? Would a combination of term and perm be better for you? One of the things we consider is and as you could see, I have access to a full range of companies. What company would be better for you based on your current health? So as it happens, when it comes to underwriting, which is the process of approving a policy from both a health and a financial perspective, some companies are more lenient than others. So if I know I'm dealing with a client that has a lot of pre-existing health conditions or something serious, I know that there are some companies that are likely to give that client a more favorable evaluation. We can do a whole other session on what we call simplified issues companies, which, for clients who have like serious pre-existing health conditions, and they may say, well, I can't even qualify. Well, actually, there are an increasing number of companies that are willing to take a chance and offer coverage even for clients that were previously very hard to insure. We would then go through the application process. These days, by the way, the entire process can be done online, which is a nice benefit that's come out of the lockdown. This is just one of the few things I like about it. Less paperwork, because in the past there was a lot of paperwork. Now it's all moving online, and it's a seamless process. Most of the companies have already moved online, and they have what we call e-apps. Once you fill out the application, now you can choose to pay the initial premium. As long as you're in good enough health, you can choose to pay the initial premium and be covered from day one on a temporary basis. Or you can say, you know what, I'm not even going to pay the first premium. Let the insurance company do its homework on me and evaluate my health, and then I'll make my decision. So then we go, after you fill out the application usually asks a number of health questions. Okay, depending on the amount of coverage that you apply for and the age of the client, there may be underwriting required. Generally, the older the client, the higher the amount of coverage, the higher the amount of requirements. They want to, the insurance company wants to know that, you're not gonna be a bad risk, you're not likely to pass away like this. So, after the health questions, depending on the amount of coverage, some of the underwriting requirements may be blood work or urine. Right now, because of COVID, we're actually in a more favorable time than ever. So right now, companies are offering, because for a while, the paramedical companies, the ones that would normally send the nurse to your home to do the blood work, they actually took time off. They were not even offering exams. So what companies have said, well, for clients under the age of 50, as long as their health is good, we'll offer up to 2 million of coverage with no blood work. Okay, you still have to go through the medical questions, but with some companies, it's as little, it's as little as 12 questions to get up to $1 million of coverage. Pretty neat. And it can be approved literally within 48 hours. I've seen it happen. But typically, that's the whole process is like this. We do the need analysis, we figure out what type of plan is ideal for you, which company we should go with, and again, depending on the client's situation and health situation and so on. Once the underwriting process is complete, the insurance company will make an offer. So even though I may be quoting you, like the numbers I was showing you on the screen, those are numbers that apply for somebody who's in average health, who typically has no pre-existing conditions or maybe only minor stuff that has been taken care of. In those cases, that would be, a standard premium. You've been approved, good to go. Once you get approved, you can say, okay, yeah, I'm taking this. If you're one of the fortunate few that is actually in better health than the average person, you may actually qualify for preferred premiums in some cases, where your premiums could be as, up to 25% lower than the listed standard premium. That is a minority of clients. And, another minority of clients, unfortunately, would qualify for what's called a rated premium. So the insurance company may come back and say, well, thank you for your application. After carefully evaluating your health history and everything else, we're willing to offer, but it's going to be at an extra premium because of your pre-existing conditions. And usually those clients, we know ahead of time. Once I go through the questionnaire, I usually let the client know, just so you know, this type of health history will typically entail higher premiums. And the clients know. Clients are not, they know. Obviously, they understand the reasoning behind that. And by the way, if at the end of the day you get an offer and you're not happy with the offer that the insurance company made, you can always, because I'm a broker and I have access to the entire marketplace, we could potentially look at one or two other companies that may be willing to give you a more favorable evaluation. That being said, right from the get-go, especially when I ask the client if there are any pre-existing conditions I should know about, I typically will go to the company that I think is best and more lenient from an underwriting perspective. But once you get approved and you get the offer, and I always like to tell clients, bird in hand is better than 10 in the bush. If you've been offered coverage and it's not, super ridiculous premiums, you're better off taking it, and then we can shop around for you to see if we can get you something better. But take the policy, because you never know, especially in these uncertain times that we're in right now. Companies may decide, well, for policies that are still in the underwriting process, they're not officially enforced yet. Well, now clients have to submit themselves to a COVID test. I mean, that would be the worst case scenario, but we're in very fluctuating market conditions right now. So I always say to clients, bird in hand is better than 10 in the bush. Take the offer, and then, we can shop around for you some more if we can see if we can get you something even better. And that again only happens if you happen to be in that minority of client that is seen as, not being in average health. So with that said, you guys, that's my contact info. This picture is not Photoshopped. I can't believe it. I dared to put a picture up. It's not Photoshop. But anyway, that's my contact info, everyone. You're welcome to reach out. And if you have any questions or you'd like to get a personalized consultation, those are free, by the way. So yeah, I invite you to reach out. Let me see if there are Any questions, you guys? Thanks for listening. Thanks for watching, Facebook people. Okay. Okay, I don't see any questions. Even if you have questions, let me see if I'm going to reload the page. Sometimes they come up after. No, I don't see any questions. That's all good, guys. Everyone, thanks again for watching and listening, including those of you who may be catching this presentation after the fact. I wish you all a great rest of the week, and I'm sure I'll see you, at least some of you, on my future live streams and in person. Take care. Have a great rest of the week. Okay, bye for now.